Well, joining me now is Wharton School Professor of Finance and Wisdom Tree Chief Economist Jeremy Siegel. Jeremy, it's great to have you on the show. Welcome.
Good to see you, Morgan.
So where do we go from here with stocks?
Well, as I've been saying for a long time, make the trend your friend. The trend is on. But Mike Santoli is right. It's been a long time since we've had any reaction. But at this point, I don't see anything immediately that is derailing the trend that we're seeing, and not even the government shutdown. It seems like the betting markets thinks it could go anywhere from 10 days to 2 weeks. I think anything longer than that could really weigh on sentiment. We did get a little nick on consumer sentiment in the last confidence level reading. What I'm really looking for this quarter, I mean, certainly we're going to get earnings for the third quarter. I'm looking for any reaction to tariff hikes that I think are going to be more prominent in the fourth quarter than we've seen all this year. As Christmas and retail spending come on, is there really going to be resistance at the low end? And, we might not see that for a couple weeks, but I think that that's really going to be the big story here in the fourth quarter. However, with that ADP report, it still looks to me, I'm still saying the Fed on October 29th, it's probably going to go down another 25 basis points and one final cut in December.
Okay. I guess given the idea that maybe coming into the fourth quarter, you start to see more impact from tariffs, is it transitory? Because that's just as important when you talk about the Fed's next moves, right?
Yeah. I mean, listen, what I've been saying all along, it's like a tax that is put on all imported goods. We will have a bump in prices. It's a one-time bump. And I've always recommended that the Fed look through that and not tighten or delay in loosening credit as a result of that. And it will give some shock to a downward on consumption. However, nothing that approaches what I think is a recession. And with everything else positive going on in terms of capital spending, AI spending, and all the rest, I mean, that's just producing the earnings that is more than offsetting what slowdown there could be in the consumer in the fourth quarter.
Amid the government shutdown, you do have this data desert, if you will, at least in terms of the federally generated data around things like jobs report and jobless claims. But we were having this conversation with Steve Leisman here yesterday on the show, and this idea that maybe this is an opportunity for economists and investors and analysts to get off the data-dependent hamster wheel and sort of pull in more inputs in terms of their analysis. How do you see it?
Well, and I heard Steve say that, and I think there's a lot of truth to that. I mean, we get so hooked on each of these reports. We see all the errors in this report. Listen, here's a real case for the private sector to step up, and we do have private sector sources. I mean, we had ADP, and that definitely influenced the bond market, a couple of days ago. So we do have private sources. I would like to see a lot more private sources so we don't only have to rely on the government for their statistics. So I think you're going to see a boom in private source data as a result of this slowdown. I think that's good. And remember, stocks depend on earnings. There's going to be no hesitation on earnings reports that are coming out, no slowdown there, and interest rates. And, the bond market reacts to an awful lot more than just, what those reports are coming out. There's a lot of flows of credit on and off. And so interest rates and earnings, that's what makes for the stock market. Our markets can still continue without so much reliance on the government data.